Hello, everyone. Welcome to the lecture. I hope you're doing well and enjoying the content. If you haven't watched episodes 1 and 2 yet, pause this now and go through them with a notebook because this video builds on those lessons so they matter. First of all, go and watch them if you haven't. So, today we are going a step deeper because CRT basic. Now, this lecture is about the higher time frame to lower time frame, complete thought process, how to select higher time frame, intermediate time frame, and lower time frame, what to look for on higher time frame, what to look for on the intermediate time frame, and what to look for on lower time frame. And then integrate these time frames to frame a trade. By integrating these three time frames step by step, you can build a clear logical trade and narrative starting from higher time frame analysis down to lower time frame entry. Let's get into it. All right, so first of all, we're going to pay attention to the higher time frame because everything starts from there. Now, what exactly are we looking for on the higher time frame? Our main focus here is to understand the market environment, where the market is right now, where it wants to go, how it's likely to get there, and why it wants to go there. To figure that out, the very first thing we need to look at is order flow. In simple terms, this just means identifying the prevailing direction of price delivery. Don't complicate it, just ask yourself, is the market structure currently bullish or bearish? Let's break it down. When the market rejects below a low and breaks above a high, that's bullish order flow. That's your bullish market structure. Simple. On the other hand, when the market rejects above a high and breaks below a low, that's bearish order flow or bearish market structure. When we move to the real chart examples, this will make even more sense visually. Now, the second thing we pay attention to on the higher time frame bias. Basically, bias means defining whether the market or the current candle is operating in a bullish or bearish environment. As simple as that. We are candle traders, so it all starts from the candle you're trading. Ask yourself, is the candle I'm trading expected to close bullish or bearish? You need to be absolutely clear about this before anything else. You should know whether the candle you're trading is likely to close as a bullish candle or a bearish candle, and for that, you'll read the open, high, low, close, and open, low, high, close structure properly. This is the foundation. If you don't understand what kind of candle you're dealing with, then everything that follows will be shaky, and that's your bias. Now, there are many different ways to build bias, but let me give you a simple and logical approach that actually works. Close above equals higher prices. If the market closes above the previous candle, we expect higher prices in the very next candle. Now, let's say the candle we're trading is expected to close bullish. That's our very first confluence. Why? Because when a candle closes above the previous one, it simply indicates higher prices for the next candle. This gives us a clear directional bias and sets the stage for the trade. So, before doing anything else, we've already established one strong piece of evidence in our favor. The expectation of a bullish close equals higher prices. Close below equals lower prices. If the market closes below the previous candle, then we can expect the next candle to be bearish. Now, when the market closes inside the previous candle's range, for a bearish candle, this usually indicates that lower prices are likely to follow. And for a bullish candle, it generally suggests that higher prices may be next. This idea actually connects directly to CRT, and this is one of the ways we use candle range to build our bias. Another thing to pay close attention to is the wick. A wick above the candle usually signals lower prices, while a wick below the candle usually suggests higher prices ahead. So if the current candle closes with a large wick, you can use the position and size of that wick to anticipate what the market might want to do next. Of course, you're not going to rely on these points blindly. This is just one confluence for identifying bias. You'll combine this information with logic and proper market context to frame a clear trade idea. And don't worry, In this video, we'll go deeper into exactly how to do that step by step. Okay, so let's move on and talk about the intermediate time frame and see exactly what we should be looking for here. On the intermediate time frame, we mainly focus on two things: narrative and context. Let's start with narrative. There are two types of narrative: time-based and price-based narrative, and of course, there are many variations of both. But let's keep it simple and focus on the ones that truly matter actually in market. For time-based narrative, we have Kill Zone Asia, London, and New York, right? Each session has its own unique behavior, and understanding these time windows helps us frame our expectations. We'll dive much deeper into kill zones in a separate chapter, but for now, just remember kill zone are the foundation of the time based narrative. Alongside kill zones, we also pay attention to open, high, low, close, and open, low, high, close, as well as profiles like the 4H profile or market profile, which give us structure and rhythm within the session. Now, for the price based narrative, we have concepts like PO3, time based PO3, which I've already discussed in detail on Twitter. If you haven't read that post yet, I highly recommend searching for it. It'll give you a clear foundation. Now, for price based narrative, we have other key elements include dealing ranges, turtle soup, and weekly or 4-hour profiles. All of these help us understand where price is likely to engineer liquidity, consolidate, expand, or retrace. Now, the second thing we focus on for the intermediate time frame is context. As CRT traders, we only use CRT for context. This is where candle range theory really comes into play. By applying CRT on the intermediate time frame, we can build a clearer picture of how price is evolving within the bigger picture set by the higher time frame. Now, the second thing is key levels. Key level play important role here. We don't just mark key levels on the higher time frame, we can refine them on the intermediate time frame to get a sharper entry. These refined levels often align beautifully with CRT setups, helping us shape precise trade ideas. So, to sum it up, on the intermediate time frame, our focus is on understanding the narrative that's unfolding and the context in which price is operating. All right, now let's talk about the lower time frame. This is where execution comes. On the lower time frame, our main focus is where and how to position ourselves, right? Meaning, where exactly we'll execute the trade and how we'll manage it. The first thing we pay attention to is time. We always want to align our executions with refined key times, specifically kill zones. As I've mentioned before, we'll go deeper into this in another chapter. But for now, just keep it simple. London kill zone we have from 2 a.m. to 5 a.m. UTC -5 or -4, and New York kill zone from 7 a.m. to around 10 or 11 a.m. UTC -5 or -4. Forget about your local country time. Simply change your chart settings to UTC -5 or -4 and stick to these two kill zones, London and New York. This alignment with time will give your trades structure and consistency. The second thing we focus on is entry. After a key time is established, we look for our entry model. Personally, I only trade Model 1, which is an order block entry, and I explained this in detail in episode 2. Now, I'm not saying you have to use Model 1. The point is to find an entry model that suits your style. Study it, master it, and trade it with confidence. Your entry model is your weapon. Use it with precision. The third thing is stop loss. And honestly, stop placement is one of the most critical factors in trading. Without a proper stop loss, you're not trading, you're gambling. For stop loss placement, we use protected swing highs and lows, the same swing points that created the Model 1. That's our protected swing high and low. These protected swings act as our structural defense, defining where our trade idea becomes invalid. Finally, the fourth thing is target or exit. Your exit is just as important as your entry, right? So never overlook it. For targets, you can use 50% of the CRT range or the CRT high or low, depending on the direction of your trade. And always aim for a minimum risk to reward of 1 to 2 or 1 to 3. This ensures that even with a modest win rate, your equity curve grows steadily over time. So, in summary, on the lower time frame, your job is to align with time, execute based on your model, protect your trade with logical stops, and plan your exit with discipline. This is the final layer where analysis turns into action. All right, let's move on and integrate everything together. The higher time frame, intermediate time frame, and lower time frame, and see how this plays out on a real chart. As you can see here, we've got the euro dollar daily chart, and this is going to act as our higher time frame. I'm a short-term day trader. I'll walk you through an examples that fits this trading style. So starting with the higher time frame. What's the first thing we always look for? Order flow. And if you look closely at the price action here, the market is consistently rejecting lows and breaking highs again and again. That clearly tells us that the order flow is bullish. The second thing we focus on higher time frame is bias. We want to identify whether the candle we're trading is expected to close bullish or bearish. In this case, the market closed inside the previous candle, and this gives us a clear expectation of higher prices on the very next candle. So, our bias for the next candle is bullish. Now, moving on to the third element on higher time frame, draw on liquidity. Here's a quick question for you. What's our short-term draw on liquidity in this scenario? Exactly the high of this candle. All right, that's our first draw on liquidity. And the second is this high right here. And finally, the fourth thing we analyze on higher time frame is the key level. We've got this FVG and order block for supporting price to push higher. All right, okay, now let's shift down to the intermediate time frame and see what's happening there. On the intermediate time frame, the first thing we're going to build is our narrative and market context. So let's start with the kill zones. This candle here is the 9 p.m. candle, which falls inside the Asia kill zone. But as I've said before, our main focus is strictly on London and New York kill zone. So now take a look at this 1 a.m. candle. This is our London kill zone. But notice what happened. The market didn't really make any significant move here. It just retraced a bit lower but didn't tap into the key level, which in this case is the rejection block. Now the market formed a turtle soup of this low and reacted off it. At this point, this is where we ideally start looking for entry opportunities. But since the 1 a.m. candle didn't really give us anything meaningful, no clean setup, just a retracement, we move forward. Then we get this CRT candle, and this becomes our candle range. Now, my expectation here is simple. I want to see the next move purge this candle's low while also tapping into the refined key level, which again is that rejection block. So let's drop down to the lower time frame and see how it played out. First, the market purges the candle range low and taps into the rejection block, but it fails to push higher from this area, right? Why? Because of time. Remember what I told you? The first thing we check on the lower time frame is time, and this setup formed around 5:30, which is outside our kill zones. A bit later, around 7:45, during New York kill zone, the market purged this short-term low and then closed above this specific candle. And that gives us our Model 1 entry. Now entry, we've got Model 1 during NY kill zone after the purge and close above. Stop loss. The swing low that formed this Model 1 entry becomes our protected swing low, and that's where our stop goes. Target, you can aim for the CRT high or low, or simply 50% of the CRT risk to reward, minimum 1 to 2 or 1 to 3. And if you want to hold a portion longer, you can target your draw on liquidity, but make sure to take partials before going for the big move. You see how mechanical and rule-based this framework is? There's no guessing. It's structured from higher time frame to intermediate time frame narrative all the way down to lower time frame execution. Okay, now you can see the same euro dollar daily chart. We have a clear bullish order flow and price is currently trading inside this specific candle.